Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
Hello, this is Fergus Hodgson with the Gold Newsletter Podcast. Thank you for tuning in. I mention this every week, but I'm so happy to speak with these wonderful guests. Today we have Bill Kelly. He is the CEO of the CAIA Association, which is the Chartered Alternative Investment Analyst Association. And he's got a long experience. He was founder and former CEO of Boston Partners Asset Management. He's based in Boston. And he was the CFO of the Boston Company Asset Management. I hope they've got that correct.
That's close enough.
Bill, welcome to the podcast. It's my privilege to have you.
Mine as well. Thanks, Fergus.
As you've noticed, I've been following CAIA for a while. Many of us, particularly maybe newcomers to the industry, we need these organizations like CAIA. So I'm a fan. I think there's an important role there for industry organizations that help bridge the divide between maybe the academic world and the industry world. And often they do maybe a better job than the academic world does. So, yeah, as I mentioned before, I'm curious to know, maybe you felt like you had maxed out your roles in hands-on finance and you thought you wanted to give back. What motivated you to take on the CAIA role?
There is no grand plan. As Woody Allen says, you plan and then life gets in the way. And I think that was very much true. And I think true of a lot of people. And I'm just very curious by nature. And I look at a lot of different opportunities. And the alignment of how this worked out has just been so great, even though, as I said, it was absent a grand plan. I had spent, as you indicated, Fergus, in your opening remarks, the better part of 35 years in financial services, mostly on the asset management side. I was a CPA way back when at Price Waterhouse, but really financial services and asset management since the mid-1980s. And I just saw the evolution of product. I kind of grew up more on the traditional side of the street, where the CFA was the credential in vogue and maybe less visible was CAIA. But I had made a decision to leave Robeco on very good terms. I had renewed my contract with them several times. We had sold Boston Partners to Robeco in 1992, and they were excellent partners. I became CEO of the U.S.-based business. But I found a lot of what I was doing was internally facing, and I was interested in doing something more entrepreneurial. I had to sit out for a couple of years with restrictive covenants, and as a result of that, I ended up doing some board work. And one of the managers I got involved in was bringing forward liquid alts to the marketplace. And I thought that this is kind of interesting to democratize the access to product, but where's the education attached to it? And about the same time, Korn Ferry came knocking with the search at CAIA, and the intersection was just too compelling to turn down. And I've been here about 5.5 years and love the mission more today than the day I walked in at the beginning of 2014.
Yeah, that's an interesting little term you injected there, liquid alts. So liquid alternative investments, or I guess highly traded, maybe you wanted to say. Now, what do you mean by that? Is that what you mean when you say institutional grade alternative investments?
They could be, but I think post the global financial crisis, I think a lot of investors got scorched, and while they may not have ridden the S&P as an example all the way down to the bottom floor, many people witnessed double-digit returns, and as we came out the other side, the market has a propensity to delivering what the investor wants or what they think the investor wants, whether they really need it or not. And the base case was to get the greater diversification, greater access to uncorrelated risk premium. By uncorrelated risk premium, I mean asset classes that are not going to move in the same direction as equities and fixed income. So along comes liquid alts, which is really more of a retail approach to what really had been institutional assets where you could take short positions or use some form of leverage, and these came in vogue probably just after the global financial crisis, but they ended up capping out in terms of growth several years ago because we've been in this risk-on trade that's persisted for the last 10 plus years, which is
just slow down there. Capping out 10 years ago. I lost you there.
So the global financial crisis came about
10 years ago. Yes,
we're still in it. This risk-on trade still persists. So the value proposition around diversification is still there, but it's kind of hiding in plain sight. So I think investors are thinking about a liquid alt that might not perform and might hedge some of their risk in the equity markets. They're saying, why do I need this inside of my portfolio? So I think, getting back to your original question, Fergus, I think a lot of these liquid alts came out as a diversification play for more retail-oriented investors. But what ended up happening is you took a very sophisticated institutional product that lacked maybe transparency, that could use a lot of leverage, could use a lot of illiquid instruments, and we took that and put it into a 40 Act wrapper or a UCITS wrapper where you have daily liquidity. And as a result of that, some of the upside disappears, and in many cases, these funds, while they were supposed to be a diversification play, end up looking a lot like what you had in your long-only portfolio in the first place. So there's still a lot of product out there, but due diligence is critically important on this side of the street when you're talking about alts.
His name escapes me right now, but we had your curriculum director on maybe a year and a half, 2 years ago.
Keith Black.
Yeah, and from memory, he said there were three largest areas of alternative investments: real estate, private equity, and commodities. Is that correct?
Well, I would say definitionally there's a lot of different views, but I would also, looking at our curriculum, and Keith knows this area far better than I, but hedge funds, structured products are noticeably missing from that lineup, Fergus, that you just said, and I would certainly put those on the list as well. But when we take a look at what we define as alternative investments, they really have to be institutional quality. So what's not on the list? Baseball cards, wine, race cars. These are alternative asset classes, but they fall more into the collectible category. And then cryptocurrencies really has not seen institutional adoption. I think it's been more to the 20-somethings that have climbed on board, but the institutional side has not come, so that's not something we cover either in our curriculum.
Yeah, you know, of course, the CFA has taken and incorporated that into its curriculum, but it seemed like a very quick or maybe hasty decision to do so. Are you looking to include that in the future?
Well, I think with the CFA, and a lot of respect for them, a fantastic organization. 40% of our members are CFAs, so I think CAIA can complete the CFA and CFA can complete CAIA as you think about this one continuous risk premium spectrum. So there's a lot of mutual respect. But when it comes to the curriculum, I think what the CFA has included, as best I know, is some of the underlying blockchain technology that supports cryptocurrency, but can do a lot of other things in addition to just being the distributed ledger for cryptocurrency.
Sure.
And CAIA covers blockchain in our curriculum as well. So it's the currency side, the cryptocurrency
I see.
side, that we do not cover. And I don't think the CFA may touch upon that, but I think they're probably leaning more toward the blockchain technology.
Yeah, maybe that's a distinction I wasn't aware of. So, and you just said there, collectibles versus the institutional quality or institutional grade. Where do you draw the line between the two?
Well, if you look at this industry through the lens of, say, a David Swensen at Yale, what is Swensen thinking about if he's accessing risk premia, either trying to get beta exposure, meaning just access to a specific asset class, or trying to get an alpha generator return above the asset class itself? Some of these asset classes you mentioned from your prior discussion with Keith, where I think about, broadly speaking, the private markets, private equity, private debt, real estate, infrastructure, and then some of the tradable strategies around CTAs, which are commodity trading advisors, hedge funds, or structured products. Those are the primary asset classes that you would find inside the portfolio of a large endowment, a large pension plan, a large sovereign wealth fund. And that, broadly speaking, is how I would define institutional quality.
Yeah, so in some ways it's a dynamic or moving definition, depending on how the industry evolves.
It is, and I think it gets back to your earlier point, Fergus, that we have got to sit at the intersection of what the practitioners are looking and seeing, and then also the academic lean is important too, because of the veracity and quality of a high-stakes exam, which is the demonstration of having mastered the curriculum that underpins CAIA's credentials. So we have got to continuously get allocator input, and we're fortunate now that we have 10,000 members in 90 different countries, and we talk to these allocators on a continual basis because their feedback is very, very important to us. What are they seeing? What are they hearing? What asset classes are showing up? What are less relevant? And if you look at hedge funds as an example, I still think there's some growth there, but it's going to be one of the slowest growing asset classes over the next 5 years. And it seems like private equity and private debt is a tree growing to the sky right now where we are, and there's more and more emphasis on some of the non-tradable strategies in those areas.
For more than 40 years, top financial experts and private investors from all over the world have gathered for the New Orleans Investment Conference to discover new opportunities and strategies, exchange ideas, and plan for the coming year. To learn more about today's investing environment and updates, join Peter Schiff, Brian London, Peter Bookvar, Rick Rule, Doug Casey, and dozens of experts at this year's event from the 1st to 4th of November. Go to neworleansconference.com to register. For a limited time, enter promo code PODCAST for a free Gold Club upgrade.
Well, yeah. So my main interest, I was listening to one of the CAIA presentations with you, and I think Cody Durant, and you mentioned this misplaced interest in alternative assets that you said so many people are attracted, and this is the Gold Newsletter podcast. I'm not going to dismiss this. It's a fact. People are attracted to precious metals often because they're hoping to get a big return, a big payday. And why do you de-emphasize the alpha or the higher returns and emphasize the beta or the spreading of the risk?
Well, I think if you look at expectations in the marketplace, despite what's gone on, and if you look at the Wall Street Journal today, the major market indices seem to be hitting new highs, and we just had an incredible start to this year, calendar year 2019.
Okay.
But I think if you look at longer term, most investors and most allocators will tell you that the 60-40 model, 60% equities, 40% bonds, on a nominal basis before inflation will be yielding probably 5%. So you put 2% inflation on top of that, you're lucky to get very low single-digit returns. So a lot of pension plans and state-sponsored plans have return expectations of 7.5%.
Well, they're not going to get them.
And they haven't gotten them in the last 20 years. So my fear and concern is that there's a misunderstanding, a misconception about what alternatives can do. And if a pension plan, all the way down to the more retail-oriented investor who can now get access to some of these asset classes, are really going to look at this as an absolute return vehicle, I think they're going to find themselves sorely disappointed. And if you look at the private equity versus the public equity market, the correlation between those two, based on the average manager, is quite close. The dispersion of results, and by dispersion I mean how is the very best manager doing versus the very worst manager,
yes,
that's separated by thousands of basis points, and a basis point is 1/10 of 1%. So you could have the top manager returning 30 or 40%, and the bottom manager losing 30 to 40%. So your ability to find that top manager is really why you should be in this asset class in the first place. And so I think investors are trying to manufacture return, and what we've seen is that many of these alternative asset classes have gotten more efficient. And by that I mean, why were investors going into private equity in the first place? And if you go back, when I started my career in 1982, there were 24 general partners in the private equity space in the entire world. Full stop. 24. There's now over 7,000.
Okay.
So if there's 7,000 GPs out there with over $2 trillion of capital that they're lugging around trying to find the right deal to invest that money in, does that sound like a highly inefficient market where you can extract a tremendous amount of value? It doesn't to me. So I think that these markets have become more efficient, and finding value has become more and more difficult. So again, emphasizing my point, if investors think that they're going to find the express elevator to much higher returns and much higher absolute returns by turning to alternatives, unless you're using a leverage beta play, which broadly falls into alternatives, I think you're going to end up being somewhat disappointed.
Yeah, it just makes sense to me that as these markets do become better monitored and more efficient, any kind of disparity between the two will close, right? The arbitrage will close that.
By nature, that's absolutely true. And as you look again, I mentioned the private equity market a couple of times. The EBITDA multiple, and that's the multiple of cash flow that the private equity investor, the general partner, pays on the way in to put these portfolio companies into the underlying partnership. They were trading at about 11.5 times. That's what they were paying, 11.5 times cash flow.
Okay.
Back in 2007, right before the financial crisis. We're back up to that same level. So pricing, to use a Howard Marks word, has become very dear. And could it continue to go up from here? Yes, anything's possible. But we are at a state in the market cycle where pricing has gotten very, very expensive. And if you're thinking about going into private equity for the first time in this current vintage year, meaning where prices are very high and that's your only exposure to this asset class, again, you're looking at it through a very narrow lens.
The challenge, which you alluded to, is that if people come in with the idea that alternative investments will give them some higher return, obviously they'll go away dissatisfied, right? But so basically your case is that you can lower your volatility. So do you want to clarify that second point? I mean, this is what you write about. This is your column every week, basically, almost every week.
Yeah, it is. It is a theme that I lean on, and by lowering volatility, it means maybe, to put it in a very basic way, not putting all your eggs in one basket. So you should look at risk as an asset, and you should be compensated for risk taken. And if you're going to sit in cash, that's probably the biggest risk you can take, because net of inflation, if the risk-free return is 2.5% best case and you've got a 2% inflation, you're standing still. So you've got to look at how you're going to get invested and how you're going to stay invested. And having a more diversified portfolio, so if the equity market is down 30%, but your portfolio is only 20% invested in equities, you're only down 6%. So your ability to stay in the market and not get panicky and jump out at any twist and turn is going to be much more likely. But if you look at time and time again, the propensity for investors of all levels of sophistication to run for the exits, we see it all the time. I'll look back just to the month of December. Not too long ago, and the month of December showed us a Fed that was going to finally start to tighten. You had Trump kicking Chairman Yi in the kneecaps in China, or Chairman Xi, and then you also had the government shutdown. So investors got very, very nervous, and we had the worst December since 1931. And if you look at the Lipper tracking of fund outflows in long-term funds, so these are not money market funds, these are mostly long-only equity funds, it was twice the level of the highest outflow ever since Lipper's been keeping this data. So investors panicked. But then what happened in January? January off to the races again. The Fed all of a sudden gets very dovish, and we have our best January in 30 years. How many investors came right back in the 1st of January and grabbed that upside at the same time? Probably very few. And I think there are a lot of investors out there, say folks of maybe my parents' generation, that got scorched going into retirement 10, 15 years ago, or say 10 years ago at the global financial crisis. Some of them are just coming back in now, so they've missed this entire run up. So I think your best bet is to try to figure out a way of staying fully invested by diversifying your risk across many different asset classes, so you're not having full exposure to any one twist or turn in the marketplace. And I think most investors want 100% of the upside and 0% of the down. And I can guarantee you, Warren Buffett can't find that, Howard Marks can't find that. Nobody is capable of doing that.
Yeah, we're getting basically to the theme that alternative investments are becoming more mainstream, particularly, as you said, these pension funds are struggling to maintain or failing to achieve their targets. Is that name a problem, calling it alternative investment, if these investments are just more ubiquitous?
The short answer, Fergus, is yes. And then you may say, well, geez, you've got a problem with your branding and logo because it's in my name.
It's stuck. Yeah.
Yeah, but I think both in terms of the perception of the investor, and then I think the media bias to maybe get the value proposition of what alternatives can and should do in a portfolio more wrong than they get it right. So if you look at just the broad definition of alternative, equity is an alternative to fixed income. Fixed income is an alternative to cash. Cash is an alternative to private equity, and the list goes on and on. And if you look again, and I use him as an example quite often, and although I've never met him, David Swensen, if you look at Swensen and you were to ask him, what percent of Yale's endowment do you allocate to private equity? He would look at you like you're crazy. He turns around and looks at an entire buffet of asset classes and risk premia and decides what is going to get him the very best risk-adjusted return, and he builds his portfolio accordingly. And if you were to ask him what percent is in private equity, he could probably tell you as an output after the fact. Well, if you want to do the math, I guess it's 30, 40%, whatever the number is. But he does not go and sit back and say, should I be 30 or 32% in private equity? He simply does not think that way. So he basically looks at the liabilities and commitments he has on the other end of the spectrum in terms of funding the plant and equipment at Yale, supporting the tuition, whatever the case may be. So he knows what the expectations are and the call in his capital is going to be, and he's got to build a portfolio that's going to have a return stream that's going to be equivalent to that. And that's why I think you mentioned it earlier, Fergus, the public pension plan space.
Right.
They've got a gap that is probably hundreds of basis points apart. They're continuing to make promises to retirees, and the demographics are moving away from them at a very rapid rate, meaning they've got more retirees living longer than they have workers coming in to support those promises made, which is a very dangerous setup.
Yeah, it's a big problem. I've been following that one for a long time, and a Mercatus Center researcher just said that these pensions, the defined benefit pensions, are basically assumed with almost 100% certainty. And yet, people are trying to assume 7 or 8% returns, when in fact, if you want 100% certainty, you've got to take much lower risks. So that's the fundamental problem there. So the way you explain it in terms of the name is that it does not mean contrarian. I guess that's maybe the confusion that some people might have, that alternative investment means you're sort of running against the current or something. It maybe has more of a just a category that has this name maybe for historic purposes, but in the future that name will not have the same connotation.
Exactly, and I think, so a couple of points on that, Fergus. One is that if you look at historical correlations, and this chart's out there that I think most of your listeners or readers could quickly understand, which it basically looks at every asset class and lines it up against the other asset classes, and a correlation of 1 means that they move in exactly the same direction. So if one is up 10, the other is likely to be up 10, and then vice versa. A correlation of 0 means that it has no bearing one way or the other. It could zig when it zags or zag when it zigs. -1 indicates a perfect inverse correlation. So if one asset class is up 10, the other's down 10.
Yes.
You're never going to find perfect -1s, or the zeros are maybe a little bit harder to define. But you want to try to find as many uncorrelated asset classes as you possibly can. And when I think about alternatives, those are the alternatives you should be thinking about. So you look at equity, you want to be looking at something that is uncorrelated to equity. But herein lies the problem, and I mentioned due diligence and I mentioned dispersion of returns. If you look at the correlation between private equity and public equity, it is very, very high. It's probably 0.8. 0.8 meaning very close to 1. On average, that is the case, because the dispersion is so wide. So private equity, if your ability to find that top quartile manager, you're going to find a return stream that's going to have an asset class premium, meaning a premium above the public markets, that's going to be substantial and is going to add value. Same is true with hedge funds. The average correlation is probably close to 0.9 to the equities. But again, the dispersion of results is very, very wide. And the last point on this is that when you think about hedge funds, and again, this is where the media gets more wrong than right, hedge funds are not an asset class. It's an industry.
Yes,
it's not an asset class. And I say that because there's 10,000 of them out there. And the correlation on average is very high, but the dispersion is very high too. So again, if you want to say, well, should I be 10% in hedge funds, it is a false statement. You should be thinking about looking at specific hedge funds, getting under the cover and understanding how it correlates or doesn't correlate with other things you have in your portfolio. And that is going to get you to the promised land. It requires homework, it requires due diligence, and if you can't do it yourself, you've got to be working through the lens of an informed and trusted advisor.
Okay, so yeah, the website of CAIA is just CAIA.org, CAIA.org. Are there any gateway or canon books that people might read before, let's say, jumping into a curriculum?
So first off, there's plenty to be read out there, and I think most investors are not nearly as literate as they should be. So
Sure.
while I would love to say they should all run out and get their CAIA, that's not for the faint of heart. It's a high-stakes exam, about a 60% pass rate, and many of our exam takers are pretty seasoned professionals in this industry. The average age is 31, 32 years
So
old.
even the people with experience are struggling to get through this one.
Yes, to some degree, and not, I said 60% pass rate, but we're seeing the CFA that's worked in the traditional space, and now they're rightfully so thinking about this as one continuous risk premium spectrum. They're saying, hey, I need to get my skills deeper in the alternative space, and they're marrying the CAIA credential up against the CFA and vice versa. So we're seeing people later on in their career taking this credential on. But that being said, back to your point, there's plenty of ways of accessing and staying smarter about this space. And one of the things that may be very self-promotional on my side, CAIA's got this website, allaboutalpha.com, and I write it's now about biweekly column called What About Beta? And I really try to bring forward things in the marketplace that I think are interesting to the new investor, and I try to put it in very plain English.
Yeah, it seems more qualitative. Yeah, it's not too technical.
Exactly.
Yeah.
And what I'll often do is I'll link it to something, maybe a more serious article that we have in one of our journals that in and of itself might not be approachable, but it's a little bit of a softer entry point to say, if you're going to be thinking about reading this article, here's a way to be thinking about it, and here's the entry point. But I think just reading the Wall Street Journal, Barron's, there's a lot of very good online tools as well, and I would encourage all investors just to get a little bit smarter, because even if you're going to be hiring an advisor, you need to have the confidence and the courage to be asking them the right questions. And if they're not willing to explain it to you in plain English, then you fire that advisor and go someplace else. It's complicated, but not that complicated.
Sure. Okay. Bill Kelly, CEO of CAIA, thanks for your time.
Thank you, Fergus.